Moving to a low-tax state feels like an instant pay raise. The numbers on paper look clean, simple, and exciting. Many Americans pack their lives believing they just found a shortcut to keeping more of their income. The reality is deeper, layered, and far more connected to everyday spending patterns than most people expect. Today we are going to break down what actually happens when someone relocates for lower taxes, and where the real financial pressure quietly shifts. Every year, thousands of Americans move from higher income tax states like California and New York to places such as Texas, Florida, and Tennessee. Public migration reports consistently show this pattern. The headline reason is simple: no state income tax in some of these states. That line alone creates a powerful emotional pull. If someone earning $150,000 moves from a state with a high income tax rate to one with zero state income tax, the projected yearly difference can look significant. Here is the part most people calculate first. They multiply their income by the previous state tax rate and compare it to zero. The result feels like guaranteed savings. That is the visible layer. The invisible layer begins with housing. Low-tax states often experience rapid population growth. When people arrive in large numbers, demand for housing rises. Builders respond, prices adjust, and local property values can climb quickly. In many fast-growing metro areas in Texas and Florida, home prices increased sharply during recent migration waves. Higher demand influences rent as well. A family that expected lower overall costs may face monthly housing payments that offset a large portion of their projected tax savings. Then comes property tax. States without income tax frequently generate revenue through other channels. Property tax rates in parts of Texas are among the highest in the country. A homeowner who saves on state income tax might pay more each year based on assessed home value. When home prices rise due to demand, the taxable value often rises with it. The shift becomes clear. The tax structure changes shape rather than disappearing. Sales tax is another layer. States like Tennessee rely heavily on sales tax revenue. Daily spending carries embedded taxation. Groceries, household goods, appliances, dining, and services accumulate small percentages that compound over the year. For high-spending households, this matters. Someone who maintains a premium lifestyle may quietly transfer a portion of their income through consumption taxes rather than income tax. Now consider wage levels. Certain industries pay differently depending on geography. Technology salaries in established hubs can exceed similar roles in newer markets. A professional relocating for tax reasons may discover that local pay bands adjust to regional averages. A smaller paycheck combined with higher housing costs can narrow the expected financial gap. This dynamic appears in corporate compensation data across multiple industries. There is also the cost of climate adaptation. In hotter regions, electricity bills often rise due to air conditioning usage across long summers. Utility expenses become a steady monthly line item. Transportation patterns change as well. In car-dependent metro areas, fuel and maintenance costs increase compared to cities with developed public transit networks. Another overlooked element is professional network density. Large business ecosystems create opportunity through proximity. Certain states host concentrated industry clusters. Relocating may reduce immediate access to those networks. Income growth potential sometimes slows if professional ecosystems are thinner. This factor rarely appears in tax comparison spreadsheets, yet it influences long-term earnings. Short-term math focuses on tax rate differences. Long-term wealth building depends on income growth, cost stability, and asset appreciation. If housing markets in destination states become overheated, entry prices rise quickly. Buyers entering at peak demand may face slower appreciation in later years. Meanwhile, selling property in a high-cost state can trigger large transaction costs. Real estate commissions, moving expenses, temporary housing, storage, and travel add up. These transitional costs can equal several years of projected tax savings. There is also the psychological spending shift. A perceived income boost often increases discretionary spending. New environment, new restaurants, new social circles, upgraded neighborhoods. Lifestyle expansion can absorb financial gains quietly. Data from consumer behavior studies consistently shows spending rising after relocation, especially when households believe their cost burden has decreased. Business owners face additional complexity. Some states market themselves as business-friendly with simplified regulations. Filing fees, franchise taxes, and compliance structures differ across jurisdictions. The surface message highlights low income tax. The detailed reality includes administrative adjustments and operational cost differences. A business relocation requires careful modeling rather than headline comparisons. Here's the key shift in thinking. A low-tax state changes the distribution of expenses across categories. Income tax may decrease. Property tax may increase. Sales tax may increase. Housing demand may increase. Utilities may increase. Wages may adjust. The financial outcome depends on personal income level, spending habits, housing choices, and career trajectory. For high earners with stable remote income and modest consumption patterns, relocation can create measurable savings. For middle-income families purchasing homes in fast-growing markets, the difference may be narrower than expected. For individuals whose careers depend on dense industry networks, opportunity cost becomes part of the equation. The decision requires full-picture modeling, income after all taxes, housing costs based on current market data, property tax projections tied to realistic valuations, sales tax impact based on actual annual spending, utility averages, transportation patterns, professional income growth trends, transition expenses. When Americans move for lower taxes, they are not simply changing a rate. They are entering a different financial ecosystem with its own structure, incentives, and pressure points. The headline sounds simple. The system behind it is detailed. Understanding that system is where real financial clarity begins. The financial conversation around moving to a low-tax state usually begins with excitement and ends with a spreadsheet. What rarely happens is a structural review of how state revenue models shape everyday life. Every state must fund infrastructure, schools, emergency services, transportation systems, and public administration. The difference lies in how that funding is collected. When income tax is absent or lower, the revenue burden shifts elsewhere. That shift influences property markets, consumption patterns, and business behavior in ways that directly affect household finances. Start with state revenue composition. States like Florida and Texas generate large portions of revenue from sales taxes and property taxes. This structure encourages strong real estate activity and consumer spending. As population increases, property demand increases. Local governments respond through property assessments. Over time, assessed values track market prices. When migration accelerates, assessment growth often follows. Homeowners feel that impact annually. In contrast, high-income tax states rely more heavily on earnings-based contributions. Revenue fluctuates with employment and salary trends. This structure distributes tax responsibility differently across income brackets. A relocation decision therefore involves moving from one revenue design to another. That design influences how predictable or variable annual expenses feel. Consider a remote technology professional earning $180,000. In a high-income tax state, a portion of earnings flows directly to the state. Relocating to Tennessee eliminates state income tax on wages. The immediate calculation shows thousands saved annually. Now layer housing. If the professional purchases a home in a rapidly expanding metro area, competition drives prices upward. A $600,000 purchase at elevated demand levels creates long-term exposure to property taxes tied to assessed value. If local property tax rates are significant, yearly obligations can reach 5 figures. That payment recurs annually regardless of income fluctuations. Next layer: consumption. Sales tax rates in some low-income tax states exceed those in many higher-income tax states. Large purchases such as vehicles, furniture, appliances, and home renovations carry embedded tax costs. Families with higher consumption profiles feel this difference more strongly. Over a decade, cumulative consumption taxes can meaningfully narrow the initial projected savings. Utility structures add another dimension. In warmer climates, cooling expenses remain elevated for much of the year. Energy pricing varies by provider and grid infrastructure. Extended heat seasons increase household electricity demand. Water usage patterns may change depending on landscaping and climate. These costs rarely appear in relocation marketing materials, yet they influence monthly cash flow. Transportation infrastructure also matters. In car-dependent regions, households often maintain multiple vehicles. Fuel, maintenance, registration fees, and parking costs become recurring expenses. Urban areas with dense public transit reduce some of these costs. A move from a transit-rich environment to a car-centered metro area shifts transportation spending upward. That shift compounds over time. Now examine labor market concentration. Established economic hubs create high salary ceilings due to competitive employer ecosystems. Finance, technology, media, and specialized medical sectors cluster in specific states. Relocating away from those clusters may limit lateral mobility or reduce exposure to premium compensation bands. Remote work reduces this constraint for some professions, yet not all industries operate remotely at senior levels. Income growth potential shapes long-term wealth more strongly than short-term tax savings. Another factor is homeowner exposure to market cycles. Rapidly growing states often experience sharper real estate cycles. In expansion periods, prices rise quickly. In cooling periods, transaction volume slows. Buyers entering during accelerated growth phases must consider valuation sustainability. Property taxes tied to peak valuations continue even if market conditions moderate. This dynamic affects annual carrying costs. For entrepreneurs, relocation decisions require evaluation of business climate beyond income tax. State filing fees, local permitting processes, commercial lease rates, payroll tax structures, and workforce availability influence operating margins. Some low-income tax states promote streamlined regulatory frameworks. Others offset income tax absence with business-related fees. A careful review of state revenue reports and local compliance requirements provides clearer insight than promotional summaries. There is also the impact of federal taxation. State relocation does not change federal tax obligations. High earners remain subject to federal brackets regardless of state. For some individuals, the relative weight of federal taxation reduces the overall percentage impact of state tax differences. The net effect may be smaller than expected when viewed as a proportion of total tax paid. Demographics influence long-term financial sustainability as well. Rapid population growth strains infrastructure temporarily. School capacity, road expansion, and public service demand increase. Funding adjustments follow. Over time, local governments may modify property tax assessments or introduce new municipal fees to balance budgets. These adjustments alter the cost landscape gradually, rather than suddenly. Healthcare market pricing varies regionally. Provider competition, hospital networks, and population density affect service pricing structures. Employer-provided benefits also vary by region and industry. A relocation that changes employment may alter benefit packages, indirectly affecting household expenses. Climate risk exposure shapes property markets in certain regions. Coastal areas face weather-related risks that influence construction standards and housing supply. Inland regions may experience other environmental pressures. Housing demand incorporates these factors into pricing. Buyers should evaluate long-term maintenance and resilience costs when comparing markets. Education quality influences property valuation. Areas with strong public school reputations often command premium housing prices. Families prioritizing school districts may pay elevated home prices even within low-income tax states. The premium effectively reallocates tax savings into housing cost. Social integration expenses are another subtle factor. Relocation involves rebuilding professional and personal networks. Community engagement, memberships, local activities, and social participation often increase discretionary spending during transition periods. The psychological sense of financial relief may reduce spending discipline temporarily. Let's bring structure to this. A comprehensive relocation evaluation includes 6 financial layers: net income after federal and state taxes, housing acquisition cost, and projected property tax consumption tax impact based on realistic spending utility and transportation adjustments, income growth trajectory within the new labor market, and transition costs including moving real estate commissions and temporary housing. Model each layer over a 5 to 10-year horizon. Annual savings in state income tax should be compared against recurring property tax obligations and elevated housing prices. Sales tax differences should be estimated using actual historical spending. Utility averages can be researched through local provider data. Wage comparisons should be grounded in verified salary reports for the specific role and experience level. Public migration data shows that many Americans continue relocating to lower income tax states. For remote professionals with stable earnings anchored to national pay scales, the financial outcome often favors relocation when housing is purchased strategically below peak demand and spending remains controlled. For households whose income adjusts to local wage bands or who purchase property at elevated valuations, projected savings may compress significantly. The financial reality rests on alignment. Income structure, career flexibility, housing timing, spending habits, and long-term plans must align with the revenue design of the destination state. A move driven purely by headline tax rates lacks depth. A move evaluated through a full system lens provides clarity. When evaluating relocation, think beyond the rate printed on a tax chart. Think about the ecosystem you are entering. Every state collects revenue. Every market prices housing based on demand. Every region structures daily costs differently. The surface narrative is simple. The financial mechanics underneath are detailed and interconnected. A well-planned relocation can strengthen long-term financial positioning when income stability, housing entry price, and spending discipline align with a new environment. A rushed relocation based on a single metric can shift pressure from one category to another without improving overall financial health. Before making a decision, build a realistic 5-year projection. Use actual numbers from current housing listings, local property tax records, verified salary ranges, and average utility costs. Evaluate your spending history honestly. Factor transition expenses fully. When the complete picture supports the move, the savings become structural rather than temporary. In personal finance, geography influences outcomes more than most people realize. Choosing a state is choosing a financial structure. Choose with clarity, and the results follow the structure you understand.